Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Angelo Zino of CFRA still bullish on Nvidia ahead of this afternoon's earnings results. He's looking ahead to the company's launch of its advanced Blackwell chips, thanks to the promise of greater market share. Angelo joins us now for more. Angelo, welcome back to the program. A question I think we've got to lead with is a question that you've been addressing in your note as well. When will the data center capex actually let up? When will we start to see some softness in the year ahead?
Yeah, I mean, I don't know if you start to see softness, but I think you definitely see some sharp deceleration in terms of the data center capex spend. I mean, we're looking at about 35 to 40% growth here in calendar 2024 from kind of the big five spenders out there. We know who they are in terms of the hyperscalers, the big four plus Oracle are the names we kind of look at. And then as you kind of go into calendar 25. Initially, we're kind of, pegging more of a deceleration towards about 15 to 20% growth. Still very good growth. And then I think the question is all going to be, what are we looking at as we kind of go into 26 and 27, right? And right now our placeholder is about 5 to 10% capex growth as we kind of look in some of those out years into 26 and 27. But that said, we do see potential upside to those expectations, more of a bias to the upside than the downside. But that's how we're looking at it. It's not necessarily a let up in terms of capex spend. It's more, sharp deceleration from likely unsustainable growth trends that we're seeing. And you're seeing it right now in Nvidia's numbers, right? I mean, the last 2 quarters, they saw their data center business grow north of 400%. That's clearly not sustainable. We're looking at, closer to 140% growth here in the July quarter, and that will continue to decelerate also over the next couple of quarters.
So we're talking about the size of the pie. The pie will continue to get bigger, just not at the same rate. Can we talk about the slice of the pie? Is there any real upside to overall wallet share? And is there a threat coming from anywhere? How big is that moat around this company?
Yeah, so, I think that's an interesting question. So as far as Nvidia is concerned, I think a lot of, people out there kind of look at the competitive pressures out there as far as GPUs are concerned. And you got the likes of, the AMDs of the world, which, we love what they're doing. We like the recent acquisition they kind of made. They are kind of, definitely kind of filling up kind of what they need in terms to better compete with Nvidia on the GPU side of things in a growing market. So, that's great from a competitive standpoint. But as you kind of look more broadly for Nvidia on kind of, the data center wallet share, as they kind of roll out some of these new offerings with Blackwell, with a new kind of Spectrum X Ethernet offering out there, this new kind of Blackwell offering is really intended to be more of kind of this platform offering rather than kind of just a GPU offering. So what we mean by that is not only the GPU, but the CPU as well. Going to be more ARM-based in nature, we think, as you kind of see these next-gen data centers really take off. And that's important because we haven't seen ARM-based CPUs out there find any success in the market. When you kind of just look at, Intel's recent guidance out there, they're clearly not seeing the orders on their end. We think you're going to see something different over the next couple of quarters from Nvidia, specifically kind of as they turn more into this platform-based offering. And that will kind of give them a next kind of leg up in terms of their revenue potential here, we think, over the next 12 to 18 months.
Pairing the ideas that you just talked about, hyperscalers, the biggest investors in Nvidia, how long until Nvidia is almost a competitor to their biggest customers?
It's interesting because to an extent they are. I mean, they've got a big investment out there in a company called CoreWeave, right? Where they're kind of, they've got a big stake in there and they're shipping a ton of GPUs out there as kind of this GPU or AI as a service type offering for that company. Nvidia definitely has the potential to kind of get more on the cloud-oriented side of things. Obviously, they sell their own kind of, full suite kind of systems out there. And, over time, I think there's definitely some concern probably out there from some of these cloud players out there, especially with what Nvidia has done on the software side of things, where you can essentially, if you're an enterprise customer, go directly with Nvidia and kind of buy those total systems outright. But that said, it's so capital intensive in nature, whereas it's really, we think, is going to continue to sit with these big cloud companies. And I don't necessarily think kind of Nvidia wants to kind of get to that next level where they're directly competing with some of these cloud companies, even though to some extent, you can kind of see that taking place.
Angelo, this was awesome. Got to do it again soon and follow up after the results later on. Angelo Zino there of CFRA. So here's the latest. US National Security Advisor Jake Sullivan and his Chinese counterpart kicking off a second day of talks set to discuss a range of issues, including foreign policy and trade. Bloomberg reporting that Sullivan will aim to make clear he won't speak for the next US administration. Jon Lieber of Eurasia Group looking ahead to the next election and writing the following. Harris would maintain the status quo with regard to Taiwan and would prioritize keeping the US out of regional conflicts. Jon joins us for more. Jon, in some ways, that's been the approach of this administration as well. And in many ways, it hasn't helped. If that's the approach, do you ignite more concern and perhaps not less?
I think the goal for both the Harris and the Biden administration has been to keep guardrails around what's obviously a declining competitive relationship. And nothing that Sullivan says when he's in China and nothing that Harris or her team say in the next couple of months is going to change any of that. The fact of the matter is that Washington views Beijing as a rising threat, and they're willing to take actions and steps in order to contain that threat. But what they don't want is to get involved in another war or another actual hot conflict. And that's what this visit is all about. It's about keeping channels of communication open. It's about maintaining warm relations. And despite what they're saying, I do think this is about signaling that there be continuity in a Harris administration between what the Biden team has been doing, which sets up a contrast with what Trump is trying to do, which is a much more aggressive approach to China.
So let's talk about tariffs. That's what it ultimately comes down to, Jon. Tariffs. Tariffs in the early part of the Trump administration were about a lack of reciprocity. You're putting tariffs on us, we'll put tariffs on you. In fact, we'll go further unless you do X. Then it became about national security, much more so under this administration. We don't want to sell you this because we don't want you doing that. When it comes to leverage, Jon, and this is what I'm struggling with, the lack of clear evidence that we're able to find any real lever to gain leverage over the Chinese to influence their foreign policy. What can the West do to influence the Chinese to change their view about how foreign policy should be conducted?
I think the big thing you're getting at here is Taiwan, and the Chinese absolutely have been resolute that Taiwan is actually a part of China, and that someday will be reunited with mainland China. And that's the single biggest flashpoint and the single biggest red line for the Chinese that the Americans, they do not want the Americans to cross. And I think that's kind of hanging out in the background of this entire discussion. One thing you didn't mention when you're talking about tariffs is jobs in the U.S., because that's really what I think the tariff regime is about. It's about decoupling from China, particularly in a second Trump administration, trying to bring jobs back to the U.S. And right now, that's a bipartisan thing, with the Biden administration making massive investments in terms of subsidizing green energy in order to bring a construction boom back to the U.S. to create jobs. So that threat of Taiwan is out there. The Chinese have been very clear the U.S. cannot cross that red line. And the Americans are now saying, our goal here is actually to protect ourselves, but also to bring jobs back to the U.S.
Jon, you talked about continuity from the last administration to the new one, whichever it would be. Do we have a sense of what Kamala Harris's policies would be?
Not really. She hasn't really laid out a specific China policy, and actually she hasn't really laid out a lot of specifics on any policy. At the convention, she did make a point to talk about a strong national defense, but we don't really know what that means. I mean, the U.S. has massive fiscal challenges. That's probably going to determine the path of its national defense and the size of its military over the foreseeable future. Harris has said she wants to be strong here, but that could mean anything. And one of the questions for her, one of the big big challenges she's going to face is what happens when there's a provocation. What happens when the Chinese try to stop the Philippines from resupplying the second Thomas Shoal, for example, during her administration? How strongly does she confront them? And we just don't have a sense of that from her. Some of her personnel are going to be left over or brought along from her vice presidency. Most of the Biden people will probably cycle out, but it's really difficult to infer exactly what she will do when that 3 a.m. phone call comes.
How much is that framing some of the conversations that you're having with clients, both corporate and other governments?
I think the big question about what Harris is going to do is on the mind of every single person that we talk to. I think on domestic policy, it's a lot easier to predict. I mean, she's going to inherit a Biden platform that looks like most other kind of Democratic platforms, which won't be that different because it will require Congress. But on foreign policy, presumably she continues what she's doing with the Biden administration is doing with Ukraine. Presumably they continue this strategy of engagement with China. But what the specifics of that look like, who are the people making the decisions, these are all big questions that our clients are asking us.
John, as a journalist, we can sit here all day and complain about the lack of access. There will be a little bit of access. There will be a sit-down conversation together with her running mate. The complaints will continue regardless. But ultimately, I look at the results and whatever you think about it, the strategic ambiguity, the lack of access, the lack of clear policies, it's working based on the polls. Now, John, you and I have been talking for a while, we all have, about the so-called double haters. How deep is that pool of double haters? And how well has this administration, or rather this campaign, how well have they done at tapping into that reservoir?
Yeah, they're doing a great job consolidating support among the Democratic-leaning independents who didn't like Joe Biden. And you see this in Harris's approval rating, and you see this in her poll numbers, where it looks like over the last few weeks, a lot of voters have come back home, both to the Trump campaign and to the Harris campaign, as both of their numbers of support have risen in most polls, but Harris is by a lot more. So that double hater group is probably going to be a lot less relevant in this cycle than it was in either 2016, when Trump and Clinton were the least liked candidates ever, or 2020, when Trump was so deeply unpopular. So I think the double haters are less relevant here, and Harris is doing a very good job of presenting herself as kind of the normal, reliable, predictable option relative to Donald Trump.
Making it less relevant, though, makes it a bigger issue for the Trump campaign. And John, as you've noticed, there has been a ceiling. The former president has suffered from a ceiling of support. If that's the case, what's his strategy, and how does his strategy differ to, say, Kamala Harris's?
His strategy is to do what he's done in 2016, which is to pull out kind of a inside straight in the Electoral College and win barely enough votes to get him there. So he needs to win some combination of probably Pennsylvania and Georgia. Now North Carolina is looking a little bit more competitive, and he's going after young black voters. He's going after young Hispanic voters. He's going after the disconnected kind of voters who are supporting RFK, people who aren't regular voters. It's a high-risk strategy, but that's what he's got, because he is not your typical politician.
Jon Lieber of Eurasia Group. John, appreciate it. Thank you, sir. So here's the latest. Oil slipping once again ahead of key U.S. inventories data. This coming as both Goldman and Morgan Stanley cut their 25 crude outlook. Daan Struyven of Goldman Sachs revising his forecast to 77 a barrel, writing this: "We still assume that OPEC will raise production in Q4 as the market is potentially shifting from an equilibrium where OPEC supports spot balances and reduces volatility to a more long-run equilibrium focused on strategically disciplining non-OPEC supply." Daan joins us now for more. Good morning, sir.
Good morning.
I want to start with that last line. We talked about it yesterday as well. When you say disciplining non-OPEC supply, are you talking just about shale or everything else? Who are you talking about?
Mostly U.S. shale, because U.S. shale is the short cycle, the short-term producer that responds within a year or so to price changes. Supply elsewhere in the world is mostly long cycle, where you're also price elastic, but it takes typically many years. Taking a step back, I think over the last 2 years, OPEC has really been quite effective at balancing the market by adjusting supply and to keep prices in a fairly narrow range by historical crude standards. if OPEC goes ahead with raising production, and it's very much a close call, we may learn more in coming days, we may potentially shift to a new equilibrium with somewhat more volatility, where the new floor under oil prices becomes the break-even price of U.S. shale producers.
Let's go back to the experience of the last decade, the middle of the last decade. There was a real effort from the Saudis to discipline and almost punish shale producers. Arguably, shale producers came out of that more disciplined and much stronger. What's different about this time compared to then?
So I think, as you point out, U.S. producers have very strong balance sheets now. The reinvestment ratio is significantly lower. About 50% of free cash flows are reinvested in new projects. And so I think that means that to engineer a given slowdown in U.S. shale growth, you arguably need a bigger drop in prices, because those big U.S. public producers, their production plans, they're fairly sticky, and they're very strong balance sheets. And so to us, that means that a very sharp drop in prices is not that likely. It's more likely going to be a gradual shift lower.
Some people would argue that just structurally what you see right now is you haven't seen that increased production by OPEC Plus, and what you've seen is actually inventories getting taken down at 8 out of this past 9 weeks, this according to some industry data. I'm just wondering at what point you see this as kind of feeding on itself, especially with lower rates that might sustain the recovery. How much of a counterpoint do you really take to this?
Absolutely. So we only have a modest and gentle decline in oil prices next year, from Brent sort of in the high 70s now to $74 per barrel by the end of next year, despite a moderate but meaningful surplus we have in our balance next year. Why is that? Only slightly lower prices despite this surplus, we assume. The main reason is that we do think that oil currently is slightly undervalued, meaning that prices are a touch low relative to the level of inventories. And also, if you do get these Fed cuts, you should get some upward pressure on valuations and prices, because basically the opportunity cost of holding oil is lower when interest rates come down.
So I apologize in advance for this, but your predecessor, Jeff Curry, who now is at Carlyle, came out yesterday and he said there's going to be a huge spike in crude prices because of lower rates and because of this sort of super cycle that you see on the heels of the investment in some of the infrastructure plays that we've seen globally. Why do you so vastly disagree with that?
First of all, I would like to thank Jeff for everything we and our team learned from him. It's very much building on the shoulders of a giant. And I agree with Jeff that positioning is very low, is very light at the moment. And I also agree that oil prices currently look somewhat low relative to fair value. And that's precisely the reason why, despite a meaningful 600 KBD surplus in 2025, we have a base case of only slightly declining oil prices.
77 is the average for 2025, correct?
Correct.
How much of that is about Chinese demand softening and maybe not bouncing back?
I think that the big surprise this year on the demand side has been softness in China demand growth. Actually, it's demand outside of China is surprising to the upside, in the US, in Europe, in India. But I think the slowdown in China demand growth, which is, I think, mostly structural, is an important factor for oil markets in coming years. To put this in context, in the 5 years before COVID, China was growing its demand of oil by almost 600 KBD every year. In the first half of this year, annual oil demand growth from China was only 200 KBD. So basically only 1/3. Some of it is a macro story. GDP is structurally growing at a slower pace. But some of the factors are oil specific and more micro. Fuel switching into EVs. Fuel switching out of diesel into liquefied natural gas, which is now cheaper as well. And we think that some of those fuel switching factors are more structural.
Are we seeing that in other commodities as well? We're starting to see that in, say, iron ore versus copper, too, in China?
So I think that the sort of 2000s China-driven commodity supercycle was a supercycle where very rapid growth in China GDP, and especially the property sector, sort of lifted demand and prices for all commodities. I think we're going to enter an era with greater divergences in terms of the demand trends across commodities, with, I think, a pretty solid long-run demand outlook for copper. It's the green metal of the future. Gold, because I think Chinese, including central bank, are looking for new assets in a more uncertain world. But then on the other end of the spectrum, iron ore, ferrous metals, where I think the demand outlook looks bleak because of a structural grind down in demand in the property sector.
This was an absolute clinic, and we've got to do it again soon. Thank you, sir. It's good to see you. Daan Struyven there of Goldman Sachs on the commodity market. Lisa starting on crude and finishing on everything else.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.